Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week, I'm going to do a little follow-up on a discussion I had a couple of weeks ago we called AI 101, where I went kind of through the basics of AI. And this week, I really want to walk you through how Upstart has applied AI in the lending environment, specifically the parts of the lending experience we've leveraged AI to help us improve, the lessons we've learned, kind of the progress we've had. I think the journey of how we've been applying these capabilities in the context of lending is really informative for anybody in the banking, lending space, or any space really, about how the journey through the application of AI can look and some of the things to watch out for. So this will be a bit of a case study, but a real world application of the concept of AI specifically to the consumer lending space. So I'm going to kind of flow you through the journey of how we did it kind of chronologically, if you will, where we've really been focused on applying AI, because I think that's kind of an interesting way to follow the story. And so, when Upstart first started, probably the core thing we believed was that using AI and other techniques, we could really fundamentally improve credit outcomes, the predictive capacity of credit modeling, that really with the belief that many more Americans are credit worthy than have traditionally prime credit scores. And if you could find those people with slightly lower scores, but who would repay a loan, you could offer them credit, you could reduce the price of credit. And so we set about moving beyond a more traditional, simple approach to assessing creditworthiness to really predicting creditworthiness using machine learning techniques. The first thing we encountered was one of the standard problems for machine learning, which is the kickstart problem of, hey, if you want to use your own data to train a model, and if you want to figure out who's going to pay back a loan, but you've never made a loan, you don't have any data to use. And so our first models were a small number of variables, mostly third-party data. So data from outside lenders, either through credit bureau retros or through publicly available data from different lending platforms. And it was used to make relatively simple predictions, maybe just good, bad, maybe a singular probability of default over the course of a loan. And so we had kind of a beginning stage where we had, not enough data to use a lot of variables, not enough data to use the most sophisticated techniques, and not enough data to do really complicated predictions, and not our own data. And yet we could build a model, and that model showed really tremendous uplift. One of the things to think about when you have a model like this is also how you limit the risk you're taking on for a model that's newer and untested, right? So you've got this new model, it shows good promise in maybe your training data. And I should say, despite the lack of first-party data, lending is one of these problems, particularly credit underwriting, where the training data is actually really robust even without your own first-party data, because there is history through the credit bureaus of who's been offered loans, how those loans have performed, that can be accessed in an anonymized way to build some of these models. And so we had a pretty good model. But when you're first getting started, you kind of want to find ways to limit your risk. And I'll get to some of my lessons at the end, but this is related to one of them, which is creative ways to limit risk of the model. So there's all sorts of things you do in testing, cross-validation, accuracy metrics, to limit the risk of the model being inaccurate. Another way we worked with early on was to put some more hard requirements into the credit policy in addition to just the risk model. You can have a world where the only thing that matters is the risk prediction by the ML model. We started off with relatively high traditional credit score requirements, relatively low debt to income thresholds, where we were really operating in a constrained universe. But that gave our partners on the lending side and on the investing side some confidence that we had controls around the risk of the model being inaccurate. And of course, as that model gets more effective, as you get more confidence in the model, as it's proven its accuracy, as it's improved over time, you can loosen those. And so now we have many of our lenders and investors who don't have any credit score requirement, some that don't have any debt to income requirement. And of course, that's not to say that those variables aren't important in the prediction of risk. They're just not being used in a simplistic way with a minimum credit score, despite what the risk model might say. And so we're really relying more on the machine learning to make an assessment of risk. And that's the whole ball game here, really, in many ways, which is if you had a minimum credit score of 680, as many lenders do to start, you know that the 680 to 660 area has a lot of good borrowers in it. And if you rely on the model to find it, then you're really removing that 680 requirement, maybe making it a 660 hard requirement, and relying on your machine learning model to identify the good risk borrowers in that 680 to 660 pool. And how do I find those? And over time, then, of course, you can keep reducing that 660 to 640 all the way down until you fully remove that requirement. And so That was really how we got started, kind of applying this. And then, of course, over time, as you get more data, you're able to do a number of things, right? As you have more data, you're able to use more sophisticated techniques. Most traditional lenders using logistic regressions. You can move up into more gradient boosting. You can use more levels of trees. You can make more sophisticated models that can find higher order interaction effects. Of course, to have interactive effects between 5 or 10 variables, you need lots of data where you have these data points on lots of different loans. And so you kind of have this natural progression as you get more first party data. You have the ability to make more sophisticated models. You probably continue doing work on what we call feature engineering. So we continued to look for ways to combine the variables. Now, theoretically, a machine learning model would find all of these connections between variables. A very simple example being a debt to income ratio. It's a constructed variable, right? You get a debt load, you get an income, you make a ratio of the two. So you've taken two variables and combined them into one. And in a theoretical way, given enough training time and enough data, a machine learning model would determine all of the possible interaction effects, like a debt to income ratio or a payment to income ratio being another that you could use. It would deduce all of those on its own. But in many ways, you can think of feature engineering as a shortcut for the model to say, hey, we know that this combination of variables is really predictive, so we're going to add it as a new variable to the model. And so there's a lot of work on the machine learning side that goes into finding those kinds of constructed variables, engineering things. We did a lot of work around cash flows. Could we look at expenses and debt loads and income and figure out cash flow available to fund loan payments, things of that nature. So a lot of work goes on, and it all builds on itself. As you can do these things, you can add them to the model. The model gets more accurate, allows you to approve more people, generates more first-party data. So there's a real flywheel. And so that was really the first place that we applied machine learning. And I want to talk about two really critical moments for us in that journey from simple models, simple predictions, third-party data, to more of where we're at today. And so the two big moments, which really represented very large increases in accuracy of our model, there's a lot of small incremental changes over time. And there's moments where you see real improvements in model accuracy because you've shifted the way you do something. And two of those I really want to talk about. The first was the movement from third-party data, so loans that were made by other platforms that we access through either publicly available data or anonymized credit bureau retros, to the use of first-party data, where the training data for the machine learning models were loans that had been originated by Upstart's partners through the Upstart lending platform. And that gave us a huge increase in accuracy because, of course, we can get more data on those loans. More if you think about the training to get it, again, as a spreadsheet with every loan for underwriting as kind of a row and every piece of data about the loan as a column, we have more columns on our own data than we do on third-party data. So we have this ability to get much more accurate. Now, you need enough rows in your first-party data to train the model. And so at first we had 0 rows. We had to use third-party data. After 2 months, you have some rows, but they're both not that many loans, and they're not seasoned enough to have a good sense of performance. And so you're not using first-party data. But we had a moment where we switched to first-party data. That took a while to get to. And of course, we were testing that model and back testing it against historical loans and how accurate could it have been. And when we switched, it was a large increase in accuracy. And I guess a moment where you really feel like you've in some way start controlling your own destiny a little more because you really have your own data training the model. But that was an important evolution because we could not have started there and had to naturally use third-party data before we had generated enough data to shift to first-party data to train the model. And the second really interesting shift is as we shifted, because of the complexity of the model, as we were able to increase that and the amount of data, we were able to shift to much more interesting predictions that we were making. And so I think this is really relevant because many people who are applying machine learning to credit probably start with relatively simple predictions. You can imagine a prediction is just, will this person pay back or not? Good, bad, yes, no. The simplest kind of prediction you can make. You might move to, we moved to a more substantial probability of default. What's the probability? 0 to 1. 0 being no chance this person defaults, probably never get that. 1 being this person's absolutely going to default for this particular loan obligation. And so, moving from that, binary prediction to a probability of default to what became important to us was understanding the real components of the economics to a lender of the loan, which is not only will this person default or not, but at what time might they default? Because a 36-month loan that pays back for 35 months and charges off the last month payment is a very different economic outcome to a lender than a loan that never has a payment made, right? And so understanding what the timing curve is, and it turns out when you start to look at this, that each borrower, each applicant has a different probability of timing curve, and understanding that more in a more fine-grained way allows you to make better risk predictions, better decisions. We also went not only from a monthly probability of default, but also added in kind of monthly probability of prepayment, because prepayment also, of course, impacts the economics to a lender. And so we can combine those things. And so you can kind of see this evolution over time of, as the models get more sophisticated, they can make better predictions, right? We're still a long way from perfect prediction. A perfect model in underwriting would either say yes or no, would never get a loan wrong. Every yes would pay back 100%. Every no would have been somebody who would have defaulted had you given a loan, and you'd have very low interest rates for everybody. We're a long way from that kind of idealized state. But we've made a ton of improvements along the path there and seen really tremendous impacts to the business for our partners. And I think that evolution is a core part of how machine learning in the real world works, that you don't kind of wave a magic wand and have a great answer. You have to start simple with the capabilities that you have, the data that you have, and build and mature over time. And that's really what we've seen in our underwriting model. And it's obviously in a much better state now. And we continue to spend a lot of time because we see so much opportunity left between feature engineering, new data sources, maybe new credit bureau data sources with alternative points of data, different things we can do to improve the predictive power of that model and improve, therefore, our ability to help our partners serve consumers and to make sure they're earning the right economic rewards for the risk that they're taking. So that was really the first place we decided to apply machine learning. The core of what brought us into the space was underwriting. The second place that we really tackled and got into is interesting because it was something we learned, which was what we call the verification stage. So with our platform for our lending partners, an applicant comes in, they submit their information, the underwriting model runs and presents to them offers of credit contingent upon verification of the information that's provided. So we were given an identity, we were given an income. We need to then go back and actually verify that the things the borrower told us was true, and that therefore we can make that loan, our partner can make that loan in good faith. And when we started, again, you talk about ways to limit risk. We did all manual verifications. We had documents uploaded for every applicant. We were reviewing, bank statements or W-2s. We were looking at IDs. We were having phone calls with almost all of the borrowers. And that was, it was a process we felt was important to make sure we were really validating identity. And somewhere around, I think, 2016, late in the year, we kind of came to this question of like, hey, what would happen if we allowed a fully automated approval, right? Like we get a lot of fraud signals, and in some cases are extremely low, and we're very confident that the income is accurate, that the identity is accurate, and we're still doing this phone call and making an upload. What if we just allowed some people to go through what we called instantly, where we didn't have any manual processing, nothing to upload, nothing to review. And we started, again, to talk about ways to limit risk. We started with small percentage of borrowers that we allowed to go through this. Even of all the borrowers that we thought we probably were comfortable doing this with, we started with a small percent. We started with only small dollar loans, so maybe under $5,000 loans. 10% of the people that you think have really low scores, that look really confident that they're not fraudulent, haven't misrepresented. What would happen? And so we launched that pilot. And we saw really interesting results on two fronts, right? The first was that conversions jumped dramatically, between 2 and 3x increase in rate offered to loan funded and originated versus when we had documentation requirements. So we go, wow, that's big. If you can double your business on the same application base, that's a pretty big win. And we actually saw that there was a real question of, are they going to have hits to fraud or credit performance when you do this? And we actually in many ways saw the opposite, which brought us to the realization that good borrowers are not only rate sensitive, they want to see a good rate, they're also effort sensitive. They don't want to put in a lot of effort. And so there can be adverse selection when putting an onerous process in front of a good borrower. And so we started to say, well, how do we, if this is working so well, maybe we don't want it to be just 10% of borrowers. Maybe maybe we don't want it to be just under $5,000 loans. Maybe we want to find ways to put more people into this low risk world where we can have them instantly approved and flow through. So we started to think of this as a real machine learning problem, right? And how do we look at the data sources, the fraud data sources, the identity data sources, the income data sources that we have that are feeding data in, and make the most accurate prediction of if we think there's been a misrepresentation of something on the application, and if we think we're comfortable, given the levels of risk of misrepresentation, not having further documentation or verification. And that went from, in 2016, no loans until the very end of the year when we were working on it, to now more than 70% of originated loans that our partners have through our platform have no documentation. And that's with a maintenance of, below 30 bips of fraud on the platform. And so that's been a really interesting evolution. It's really been the second area that we've pointed the engine of machine learning, if you will, is how do we identify those applicants where the automated data sources that don't introduce user friction actually provide us sufficient data to do all the verification work. And here we're looking at a bunch of third-party APIs. A core part of that is also looking at transactional data from a depository account through our work with a third party that can access that, and user credentialed access. Of course, that's important because they need to tell us where the money goes anyway. So it's very natural for them to give us access to a bank account information. We can use that to look at things like income. But that was a really interesting ML problem. And I want to talk about it as interesting for a couple of reasons. Number one, we started, again, very tight risk controls and iterated over time. But it's a hard problem because the data is not as clean. In underwriting, you really get a very clear answer at the end of the day of whether a borrower paid back or not. I mean, at the end of the term of the loan, you have a very specific, did we make the right decision underwriting? You've got, outcome variable that we can look at and say, hey, that's a very clean piece of data. In income verification, for instance, when you stop asking for documentation because you're very confident based on automated sources that the income is accurate, you don't have a validation of that after the fact. When you ask somebody that you think is fraudulent to provide a level of documentation and say, this looks like very, very concerning for fraud. I want to really make sure this is Jeff. I made him upload a driver's license. He never did. You don't really know that that's fraud, right? So you have this really interesting problem where you don't have great incidents. Of course, in the case of fraud in particular, you don't want to have a lot of positives in your data set because that means you approve fraudulent loans. So the goal is not to do that. And so this is an interesting space where the data is less clean. The outcomes are less clear in the training data. And so it really takes a lot of work to figure out how do we build the right models? How do we tune them? How do we put the right controls and rules? And we still have a lot of hard rules in there, kind of like your minimum credit score. There's a number of those that are in this system that leverages machine learning to do this automation because it's a less clean problem. But this, is a problem that we looked at and said, hey, the opportunity to multiply, if you think about what I said, doubling to tripling the throughput from, credit approved to originated loan is really dramatic in your top line growth and your revenue, but also in your cost, because those are, loans that are going through with very, very low operational costs compared to a loan where there's a phone call or a document review that takes human time, which is one of the most expensive things we have. So we've seen great results from this, but it is an example of a machine learning problem that's a little trickier, a little thornier. The answers aren't as clear. The opportunity is probably just as big in many ways as is in underwriting, but it is at the core a harder problem to solve. And I think this is one of those areas where you have to ask yourself, what's the right problem to apply machine learning to, and how do I do that? And what are the weaknesses in the application of machine learning to this, and how do I control those risks? So those were our first two areas, really underwriting, and then this what we call the verification process that Upstart's applied machine learning. We continue to find new and different areas to apply it. So two that we're currently, I would say, are using, but are much earlier stage in our evolution of kind of applying the concepts and capabilities of machine learning to our marketing targeting. This is another great problem that's very well suited to machine learning. And who can I advertise to through what channel, with what message to actually drive not only, and this is where you the question of like, what variable am I targeting? Do they come to the site? Do they apply for a loan? Do they get a loan? Do they get approved for a loan? Do they actually originate a loan? You really have interesting questions of targeting. You have very interesting challenges in marketing around, if I reach out to somebody on 3 or 4 different channels, which of those is the one that's making the biggest difference and that is causing inaction, and how do I optimize my spending to drive behavior? The really interesting questions that machine learning can address, and we're tackling those now, although not as clean an answer. And then in servicing, where you have this question of who's most likely to go delinquent. Do I see particular portions of my portfolio at higher risk? Are there things I can do, means of outreach, messages, programs that I can leverage to improve the outcomes of those borrowers, to help them make sure they can meet their obligations? How do I target my servicing resources at the right consumers, the right customers at the right time? It's another problem that's really well suited to machine learning, and we are slowly applying that same engine and set of capabilities to these sorts of problems, as well as to new asset classes. All of which, moving underwriting from a personal loan to a refi loan is a lot of work, because there's a lot of different variables, there's a lot of different outcomes, different training data. So I think we feel we're at the very early stages, but hopefully that story of our evolution through applying machine learning in those 2 areas is interesting. And I wanted to give you guys 3 takeaways I had from kind of watching this. I'm not a machine learning expert or person, but I am have become relatively conversant. But I wanted to kind of give you 3 of my takeaways from the experiences we've had that I think are applicable to anybody in banking, lending, who's thinking about how to apply machine learning. Number 1, machine learning is not a magic wand. And I sometimes get this sense when I talk to people that they feel like machine learning is like a singular thing, and you point it at a problem or a data set and you press the button and then presto, something great happens. And there's a degree to which you can do that and often improve on the status quo. But doing machine learning and doing machine learning well are very different things. As my CEO sometimes likes to say, both Serena Williams and I play tennis, but I don't like my chances against her in a match. And I think that's very true. And the same thing is true in machine learning, which is it's easy to say you do it. It's easy to do it at a certain level, but doing it at the highest levels takes time, effort, dedication. And it's a very different thing than just getting into the game. And so understand, if you want to get into machine learning, that it's not a set it and forget it. It's not a press the button and solve the problem. It's going to take work. It's going to take iteration, whether you do that internally or whether you find a third party to work with to do it. Just understand that it's a process. It's a journey, not just a destination. And it will take time to optimize and get right. You have to learn, as well as the machine has to learn, how to really take advantage of and apply machine learning capabilities in different contexts. That being said, my second lesson is, number 1, it's not a magic wand. Number 2, be really thoughtful about the problems you want to solve. What's well suited for machine learning? Where is it not the greatest solution? So, I talked about underwriting, which is like one of the in the universe of problems machine learning is well suited to, and that has data that's well suited to machine learning. Underwriting's got to be one of the top examples of a really well structured problem for machine learning. Verification, much harder. And so, think about where to start, where you can get the best effort, best results and returns on investments in the early days. And also, I think another example of a place where people applied, AI, maybe they thought of it as AI, not machine learning, but it was kind of like the chatbot world, which I always thought was a bit misguided. Chatbots is a very hard problem. You've got to take natural language processing. You've got to have lots of possible things you could do. It's not a clear problem. You got kind of lots of layers of that. What did they say? What does it mean? What do I want to do in response? Whereas things like underwriting or some process automations are much more cleanly suited problems towards machine learning. And so figuring out if you're going to invest in the application of AI or machine learning to your business, what are the processes, the capabilities where this is well suited and we can really make a difference in the near term, I think is a really critical question to think hard about, because the answers are not always obvious. And making the wrong choice can make you think that the technique doesn't work for you, and it just may not work where you're trying to apply it. So not a magic wand. Pick your places carefully. And number 3, be creative in how you control the risk that you're taking on. Moving into something like machine learning or AI can feel like a big risk. And there always are risks involved, to be sure. But I think there are lots of really creative ways as you're going through this process to figure out, how do I control the risk? I'll give you a few examples. There were some in my story earlier, but if I'm doing it in underwriting, am I putting hard credit policy that I slowly expand over time? So I have real rails that are traditional model type variables, credit scores, DTIs that we're comfortable with controlling risk and then slowly expanding those. Do I apply things like in the verification model to a portion of my applicant pool? So I'm testing out to see the accuracy before I expand it more broadly. Am I limiting the products I'm doing it on? A lot of our partners started with us in personal loans, and that was a relatively small portion of their portfolio. So even while they said, hey, we want to really get some data and understand the performance of this model, we can use it for 100% of the personal loan portfolio because it's not a huge portion of the balance sheet of the institution. So there's ways from a portfolio size or product size, you can really control risk. And again, having kind of hard policies and verification, we still have a number of hard policies, and having good fallbacks for, hey, if the model is not certain, do I have a manual process or a traditional approach I can leverage so that I don't have to 100% rely on this approach? That's still what we do in verification, where when there's high degree of concern, we don't use an automated process. We have a person reviewing documentation, talking to that applicant, so we can get comfortable with the data being provided. So, figuring out how to fit machine learning into your overall process and find the right ways to not let the fear of risk or concerns stop you, but find smart ways to limit that risk, to manage that risk, and allow you to learn and iterate into more expansive use, I think is really important. So that's a little bit of Upstart story of the application of artificial intelligence or machine learning in the credit world. And my key lessons learned, it's not a magic wand. It takes time and effort, but the value is real. Number two, think really long and hard about how and where to apply machine learning and how well suited the problems and data you have are to the application of these technologies. And three, be creative about how you control and manage risk, but don't let risk stop you from getting started. I think the benefits of machine learning for every industry, but banking and lending in particular, are really tremendous for those who can figure out how to do it right. So figuring this out, learning this motion, and starting your process early, because I said it's iterative. So getting started early so you can learn how to leverage these capabilities is going to be tremendously valuable for the institutions that learn how to do that effectively.